Hi, Warriors. How's everyone doing? AJ, Ingmar, Ryan, you too. Richard, hell to the coach. Okay. Thank you, buddy. Hey, Mark, how are you? F.A.C.E is a place that traders come to learn to be an ace. I've seen people learn over the last almost 7 years in here quite a bit. And they like the price tag. Ryan, how are you today?
All good, mate. I'm still learning. I'm always learning.
Okay, we're growing or dying. So I drew this little speed line, spike line. You know, Ryan, I remember asking about this spike, and you said you don't know what caused it, and you know, maybe that was a hint. Maybe that was someone testing, and someone testing again with greater effect. Although, you know, it did come back quite a bit, and now the speed line comes in around 146. So, you know, you're not doing that much in front of the NFP, are you?
No, I'm not adding really to anything extra. Just doing a bit of sitting and watching, see what wants to develop, particularly in dollar yen.
Okay.
Yeah, I don't know what it wants to do right now. We've got levels developing, but you know,
this 8.5 looks important. That was this low, right?
Okay. Yeah, but we nicked through it overnight, and you know, again, it was a level, but when it goes through pretty easily, and it went over the Tokyo session, that's when I think, okay, we're not quite ready to set some real levels yet.
Okay, just to remind me, because once in a while I get old timers disease.
Old timers or Alzheimer's?
Yeah, old. Anyway, if you don't believe me, here's my proof.
Yeah.
Let
me know when you get young timer's disease.
I had dark hair before I started working.
At least you still got some.
Oh yeah, I forgot about that bonus. Okay. Anyway, euro and cable and the dollar has made a little bit of a decline here. Maybe we're getting this top in the dollar, and then again I could see another push up, but it looks like they're trying to turn the corner. I mean, is 107 viable?
I was just we were talking about that on the flow show, keeping expectations a bit grounded. You know, we've had another barrier bounce.
Yeah,
we've had a barrier bounce.
Yeah, this isn't grounded. This is like an aggressive call, 180 pips. Okay.
It's possible, but it's all, again, it's small steps. You know, we bounced from 104.50, a barrier down there. We got above 105. You know, we know how important the 105 level is, and now we're holding above it. But we can't get above 105, 30, 35. So you're not going to get your 107 until you take out these small levels. And you know, it's still pretty tight. There's no sign of the trend breaking just yet.
Okay, I did take your recommendation the other day and bought Kiwi. It looks okay. I mean, if we get through here, you know, maybe, you know, back to these highs, because look at the RSI reading. That was a pretty good mow up there. Getting a little bounce in gold and silver. Don't get excited. You know, we could rally back to 1860 if the dollar does sell off tomorrow on the NFP. I don't think it'll be the final low, but you know, that's what you need for a bottom. I actually bought some physical silver yesterday because it's not as much about precise timing as it, you know, just buy it in an area and stack it. I don't trade it. It's going to use it for, I like 1 ounce rounds in case you have to use it for exchanging things, you know, a couple silver coins for a loaf of bread, if it ever gets that bad. Okay, risk came in. This, I think.
Good morning, Dale. Good morning, everybody.
Good morning, buddy. I mean, I think this is vicious, and we have Luke Groman on today, and you know, part of his narrative was higher oil caused selling in the treasuries by China and other countries to buy dollars to buy oil. And so it's going to be a great day to have him here. I mean, $10 in a few trading days, that's
in the space of a
pretty,
week.
pretty impulsive.
Yeah, in the space of a week.
Yeah. I mean, is there anything explaining it? Is it demand destruction? No one's come out, either Saudi or Saudi hasn't come out and said that they're going to end the cuts, right?
Yeah, no, there was nothing on the OPEC meeting. It wasn't how shall I say, expected either that they would make decisions or so, but I guess that move there from 88 up to 93, 94 was enough to get the last stubborn shorts out of the way, and probably the market turning, then all the banks calling for 100, 120 bucks.
Yeah.
And here we are. If the demand is not following, at one stage it reverses, and I guess that's what we are seeing now. And yeah, it's so just it was a pain trade on the way up in a certain way, and it's now a pain trade on the way back. And I guess that under 85, 86 bucks there, people are starting to get short again. And now, are we going to push through? Is the next question. We're starting to get into interesting levels there around 80, 81, in my opinion. Yeah,
you know, when you think about it, with it really being supply cut driven, right? The rally.
Yeah, but then
that it's got to be demand destruction to take it down.
Yeah,
right?
Exactly. I mean, if you can cut your supply, but if your demand says, well, I still got enough, and don't forget the Americans are producing oil as well, you know. And if you look at the comeback in oil is now weighing a little bit on the dollar as well.
Yeah.
So yeah, this is going to be a pendulum for a while. If we get a really mild winter, why not? You know, go and do another $10 to the downside. But yeah, there's already I mean, rumors and opinions out that the Saudis may cut another 1 million barrels per day in response to this move, but we have to hear from them first, right? Yeah, for the rest, what the dollar is concerned, I'm really going to wait as well until tomorrow. The NFP, it's weakening a bit. It's following the yields which are coming off, and then tomorrow we'll see, right?
Nat gas is coming out of the space right here. So
yeah,
I mean, it was a huge saucer bottom. This is the one that looks like it has promise. Don't you think?
Yeah, I don't know how to explain it really why, but you've always been talking about those $2 level, and then when it broke 4, and then seems to really, yeah, that's a rounded bottom. All right, it's a pretty decent example of it.
There it is. Okay, so starting to get a little breakout day on it.
Yeah.
So that's been a pretty long-term base. Anyway, so maybe look at natural gas stocks. Maybe oil's played out, and you'll see rotation into this. Just a thought. And then here's S&P's 4,200 level held. I'm thinking that
has your squiggly line gotten more squigglier? I think you've improved your drawing, or maybe not so much.
A lot of it's become like so many people asking about it, I've been demoing it to people. And you know what, the $99.99 price tag that people are willing. But anyway, I'm looking at this S&P, and down here under 4,200, you could have a little 3 drive here. So maybe we get one more shot down into next week, and then we get a better rally back to 43.5 or so to correct this recent decline. Maybe we rally into the eclipse on the 15th. A lot of stuff in October. October 19th was a crash, 87 crash day. Geopolitically, the Cuban Missile Crisis was October, I believe, 19th to 26th. And, Putin's big on anniversary dates. I'm sure he looks back at that time in history as a failure and a show of weakness by the USSR. So, who knows what's going to go on there. They're, really talking about, they've showed footage of Ukrainian troops being outfired 10-1 because of low ammo. So watch out for Putin during that time frame. And you know what? It's 61 years, almost a fib number from when that happened. Don't ask me why I'm thinking about it, but I've just become paranoid. And
just because it's 61 years, is it really a retracement
in time? There are people that do fibs in time, and that's how they figure out certain cycles. Yeah.
But what I'm saying is the number 61, or being 61 years, or you could say 61 years and 8.5 months, but it has to be off of 100-year timeline period, right? So
I don't know. I'm just saying that's the distance between the two.
Got it.
If you look at a lot of your medications, what you'll see, like I have a lot that actually have 1.62% of a certain formula or ingredient in the meds. Okay. So even in pharmaceuticals, they're using, the golden rate, 1.618. So it's everywhere. So anyway, it'll be 61 years since that happened. So I was just a little kid watching that happen with Kennedy.
Hey Dale, I know you guys were talking a little bit about crude oil. Can I show you guys something?
Yeah.
So this is crude's been something that obviously been watching very carefully, because the $85 level, we talked about.
Paulie nailed it last week at our business meeting. He said can't find a crude bear.
Yeah. Yes. And we discussed that on the week ahead video. The break below 88 is going to open up 85, and it did. We got a sell off there below 88, brought out 85, hit the 50 DMA yesterday. But look at the long term. This is let me get rid of this one right here. Talk about Fibonacci's. If you take the low from May of this year to the high of this year, we're at the 38% retracement, just enough to stop out everybody who is long, right? Because they didn't want it to drop back below $85 and get probably some fresh shorts in the market. And not only that, just to see a big reversal. So you got a lot of European traders probably started getting short below $85. And sometimes you just got to take a little bit longer term view of the market and go, wait a second, that's a pretty key fib. Now, this is a nice support zone, I would say, in the market now, and you could probably read it as such. And I think we're also in an interesting kind of predicament now, because you look at all these drivers in the market. And I think the biggest driver right now is going to be yields, this move in the 30-year yesterday that just hit the 5% mark. I am looking for a little bit of a pullback. This was the chart of the day yesterday. And I think one of the things, and I wanted to talk to the guys about this, especially going into tomorrow, because we have weekly unemployment claims today, right? Now, the Challenger job cuts are not like it's not data it's going to be, it's really volatile actually to start. And it's, even though it's year over year data, let me see if I can pull up recent readings of that. where is the Challenger jobs cuts here? Am I missing it? No, there it is. Okay. Oh no, where is it? It's not on this calendar, or is it? Oh yeah, no, it's not here. I don't know why. I found it on another. Here it is. Here's another good way to look at it, or a way that we can look at it. Right here, you can see the volatility in the Challenger job cuts, but that number came in, better than the last read, and we saw yields continuing to pull back following that, and I found that rather interesting this morning, because here we are ahead of non-farm payroll. Everybody's expecting that if you have a weaker number, that's going to help out the stock market. Stocks should rally. A strong number, we should have a weaker stock market, reaction, because everybody's going to think that the Fed is going to be higher for longer. And I'm in that camp too. I believe that as well. Today kind of threw a monkey wrench in that. Ryan, what are your thoughts here? We've seen a lot of data come through the markets as far as employment data this week. Obviously, we're going to get weekly unemployment claims here in a bit. But, with the PMIs that have come out, with the Challenger job cuts, with the JOLTS data, how are you reading that going into tomorrow's NFP?
I'm reading it that the soft landing is well in play. There is nothing in the jobs that's showing any sort of red flag at the moment. So you've got to go with the trend regarding the NFP tomorrow. But you can never rule out it's still a lottery number. Jobless claims, as I mentioned on the Flow Show this morning, keep an eye on that, because I don't know if we're going to start seeing some of the strike impacting, feeding into that. 75,000 workers went on strike in the healthcare sector yesterday. And in some cases they can be classed as unemployed while they're striking, and that goes on to the claims. So that might be a bit funky over the next couple of weeks. But yeah, generally, it's all soft landing. And until we start to see some of these metrics changing, like the jobless claims, there's nothing you can say about it, really.
So what, but just looking, you can see the string of the better data that we've seen recently. Let's say you're right here, and the data comes in a little weaker. How's the market going to respond to that? We get weaker jobs data. Does the stock market continue to respond positively because yields are coming down? Because that's the formula I'm thinking going into tomorrow. You're going to see yields come down on weaker data, and the market's really laser focused on what's happening in the bond market right now. So you see weaker data, weaker yields, stock market responds positively. Do you think that's going to be the response?
I think it depends on the speed. It's whether it comes slowly down the stairs or falls out the window.
That's a good point.
We've had ADP, which has come in at 89, so that's given the market a little bit of a jolt. We've seen NFP; it's been coming down. We were getting 400s, then 300s, 200s, and now we're in the hundreds. So we're getting a slow walk down the stairs. So 50k either side of expectations. No one's going to panic about. If we start getting some real low numbers and then negative numbers fast, obviously you're going to see a bigger reaction in markets. But yeah, soft. If it comes down slowly, then it's soft landing all the way. And stocks, I don't think they rocket higher on that, because it falls into the Fed, doesn't it, and makes them right in their thinking.
Yeah, and okay, all right, that sounds good. Kman, what's your take here? Because obviously, we got with the weekly jobless claims here in a few minutes, but with NFP tomorrow, how are you looking at the data? Weak data, strong stocks, strong data?
Yeah, it depends. 75, 80K is the bar now for job creation or destruction, above or below. So that's going to be my magic number, if you want. If it's really rotten, I don't see stocks jump for very long, you know. Because we are looking at, and again, we are going to look at it every month from now, and have already. But as long as the job market domino holds up, and regardless whether we have like, oh yes, but people are taking like double jobs and whatever, the headline number is there. The market is typically goldfish mentality. Yields will, if you get a strong number, yields will continue to rise. Probably a retest of the 4,200, and then we see what happens on the S&P. Because if you have still a solid economy, there's not too many reasons to sell stocks heavily, but it does feel that we reached an inflection point on yields, especially in the long end, where if we go above these certain thresholds, it's not going to be good for stocks. So that is one that we have to look at. And then if we really collapse in the job market, then I don't see stocks hold up more than the algo blip on the first move, lower yields, because I don't think a good economy is good for the stocks. So that's how I will look at it.
All right. Well, thank you for your input. Now, I see that Grega Horvat is here, so I'm going to bring him in just a second. I want to talk about how important, you know, these levels are in the market. So, you know, whether you're looking at the E-mini futures here, whether you're looking at like a CFD, I have a lot of drawings on this Oanda CFD, but I just want to show you guys just the importance of where we're at. We have the 200-day moving average. 4,200 is a big breakout point. It's channel support, you know, any which way you want to slice it. You want to look at futures, you want to look at, you know, CFDs, or you go pull up the spiders, you're going to find the same thing, basically. This is 161% extension of the right shoulder, if you will, in the head and shoulder pattern that still is trying to play out. You can also see it's a 38% retracement of this entire move. You know, and so that multiple levels of confluence is the reason why it's been a magnet. And, you know, we've been targeting that area for the last several weeks. We're here, whether we break it or not, probably has more to do with what's happening in the bond market. The bond market, you know, is, and you know, I know everybody's used the term, you know, the dollar wrecking ball. I mean, you can call it the bond market wrecking ball too. The bond market is really in an accelerated phase of this move. You know, when you're looking at, you know, you're looking at the 30-year, you're looking at the 10-year, we're at a point where things could really spiral as far as price goes. You know, we could see it, you know, we could see the bond market really come under pressure, and yields go higher, especially if data comes out and it's just a good, you know, a good read, that's going to give the bond vigilantes just more ammunition to continue to press the downside. So I think it's going to be really important to watch the bond market in the, you know, especially tomorrow, you know, following the reaction of the NFP. I do have to point out that we are at the 127% extension of the range, the previous, you know, 2022, 2023 range in the 10-year. We hit the 127% extension, created a nice hammer yesterday. You should respect that going into tomorrow's jobs report. But, you know, will we continue in this direction is going to be all about the data. And remember that U.S. is, you know, we've used the term a lot, and a lot of people have, it's exceptionalism. You know, we're seeing the continued, you know, US dollar strength, and most of us, and I mean, US economy strength. And, you know, most people, myself included, are like, wow, you know, that's impressive. So Grega, I know Grega's here. How you doing, Grega? What's on your radar today?
Hey, well, basically we still have this dollar strength going on. But I see, as you pointed yourself, the S&P 500 is definitely testing some very important key levels. So I think that if we really are going to switch towards the risk on, we should close higher tomorrow. So we have to see some positive candles from yesterday, like a continuation. If we suddenly drop back towards the lows, then I'm afraid that we go much, much lower in the next week. And I'm afraid then there could be much more downside potential.
So yeah, so as we were just pointing out,
I think that next 24 hours, it will be very, very important for stocks.
What's that 4160 level? I'm seeing that pop up from a lot of people. That would be a 5 that some people are saying down there, one more low. But you're saying if we take out 4200, there's a big...
I think that actually we are already completing this fifth wave that you're seeing in the chart. We are already turning to the upside. So that's why I'm saying that if we really are going to complete this structure, then these recent lows should, in my opinion, hold. So it really depends where we finish the week.
Okay. But so then 4160, you're saying as to hold here, that 4160 wouldn't be a level for it to hold and then rally? That's what I see. Yeah,
I mean, it's definitely possible to see maybe some new spike to the downside, but I really do not see any kind of a bullish reversal for next week if we close bearish tomorrow.
Okay, thank you, buddy.
And what and you got this view on the S&P. What else has your attention? I mean, you look at precious metals. I mean, gold is crapping the bed. It can't sustain any type of bounce.
Grega called that.
I'm sorry?
Grega called that last time he was on, or the time before, 1800, remember?
Yeah, I don't remember, but you have a sponge brain, so you do, which is a compliment. So how do you feel about gold here, Grega?
I think that the gold is coming down into very big support here around 1800. We are in a wave C lag, as you can see. So this is the final leg of a free wave correction on a daily chart. If you switch to the daily chart, maybe.
Yeah, let me pull up the daily chart.
It's a big area. Are you backing up the truck down there, Grega?
No, I thought daily on the wave count anyway.
Oh, I'm sorry.
Anyway,
I'm sorry. Yeah, here, I'll go to daily. There we go. I was looking at the 4 hour. There we go.
Yeah, look at that.
No, you're now.
That's euro.
Oh, sorry. Damn it. My bad. I thought I had the right chart. I'll have it in 1 second. Okay. Here is there we go. Okay. Elliott wave daily. Here we go. Okay. There we go.
Exactly. So we are now approaching this former wave 4 around 1800. So it's the third leg of a corrective pullback at the 61.8%. We also came out from a triangle, and we can see that a lot of fear is going on metals. Traders are becoming skeptical, and normally, as you know, if this moves into extreme regarding the sentiment, we can expect the opposite. So I still believe that we will see a bounce on metals at the end of this year.
Wow. All right. Well, that's I think a lot of precious metals traders would love to hear that, because it has been nothing but just straight down, especially as yields taking off.
COT data will probably be very interesting this weekend.
Yeah, we'll definitely be viewing that come tomorrow. So we're about 2 minutes away from unemployment claims. Ryan, Kman, you guys got just a couple of seconds. Any last minute thoughts here before we see this data? Kman, Ryan?
Not on my side, mate. Unless we got a big variation, and I don't think it's going to be that important in the big scheme of things right now. Although a better number will confirm that the employment sector, as we've seen this week, is still doing all right.
All right. Let's see. We have, let me make sure I get data flash. The data flash, by the way, is found on the ForexAnalytix platform. You just go over to here to calendar, click where it opens up data flash. You can see it right here. I'm going to move that out of the way, move the live squawk feed, and let me pull up the chart. So you have the dollar yen over here on the left, S&P in the middle, bonds 10-year. We'll just keep the 10-year right here. Right to the right, we should have about 15 seconds till the data comes out. You can see all the data as it's released. We have some trade balance data coming out as well. I'm focused right here on the jobless claims and continuous claims. So Heads up, here comes the data. You guys bark it out if you see it before me. Trade balance just came out.
Rough.
Seems like you see a stronger print here, guys.
Yeah.
207.
Yeah. 207.
Correct.
Yeah, I mean, you know, the dollar got the initial boost from that. Not a big reaction as Kman was anticipating. I guess, you know, what I'm looking at is the equity market reaction, because look at yields. Yields are popping here. Equities are coming down. So stronger data. I think, you know, going into non-farm payroll tomorrow, you got to think, you know, if the jobs data comes in and it's solid, like what we just saw, in line with expectations or better, you know, you're going to see yields continue to rally, and you're going to see stocks continue to suffer. And 4,200 is not very far away. It's only a quick, you know,
it could
50 S&P points away, roughly. So, you know, scary times if we start taking out this week's lows in the S&P. So anyway, Dale, I know you have an interview. We have Mr. Luke Groman. He's here. I want to say thank you, Grega, for showing us your Elliott wave skills and forecasts on gold and the S&P today. Thank you very much for being here and sharing your knowledge. Ryan, Kman, always thank you guys. And if you guys don't listen to those two on the European flow show, well, the flow show in European hours, trading hours, to get ready for your trading day when Dale and I are sleeping, make sure you guys listen to that every day. And with that being said, Dale, have a great interview with Luke.
Thanks, Blake. Thanks, Stream Team. Welcome back, Luke Groman. How are you, buddy?
I am. Thank you for having me. I apologize. There was a little bit of a goat rodeo between my calendar and myself earlier this week, so I apologize for that.
You're in too much demand, Luke. I mean, you know, the RSI on you is like over 90.
Oh yeah, you should short the shit out of me here.
Yeah, no, the bullish you know, you're on national television. Let me ask you this: how many interviews do you do a week? Would you guess?
I actually don't do that many, because I try to really limit it to one, to be honest, at most. And I also make it a point to state of my commitments, and I committed to you I would be here, and B, you were an early supporter. You had me on back when, like, you know, 2017, or when I was, you know, getting going, and so I appreciate absolutely that. So yeah, this week's been busier. There's a couple I recorded months ago that are getting released this week and stuff, but you know, it's usually not too bad.
Well, you know, I sometimes the market provides the questions for me to ask of you, and let me get rid of my mug. You're off camera today, right?
I'm trying to start the video, won't let me, but I can be on video. Yeah,
all right. Anyway, the narrative that I have been reading from you is, you know, there's like this circle that because we've had a huge move up in oil, that China and other countries will sell treasuries to get the dollars to buy the oil. And they've been this has all been feeding upon itself, the dollar going up, oil going up, treasuries going down. So my question for you is, this has been a pretty vicious decline in oil. Does the narrative change with this price break of almost $15 a barrel in a week?
In the short run, yes, absolutely. What that looks like to me is an intervention. I think the Treasury Exchange Stabilization Fund stepped in and bombed oil, because where the Treasury Move Index went out on Monday with that huge drop in treasuries on Monday, or I guess it was Tuesday. It went out at 141. So we were into very dangerous territory. We were getting close to a treasury market crash, full stop. And I use that word specifically. The treasury market was very close to a crash. You would have seen yields do what repo did in September 2019. You would have seen the 10-year yield do what gilt markets did a year ago. And so
okay,
I think what we just, I think what we
You're
just
not the
witnessed
first person I've heard saying that the selling was going to come from the Fed desk.
It could be the Fed, it could be Treasury. I mean, but
okay,
in my opinion, it's an intervention. I think it is. I have no way to prove that, but it looks like an intervention.
All right.
Sorry, Dale, Luke, sorry to interrupt. I just want to say you should have the ability to show yourself on camera now, Luke. So apologize for that.
That's okay.
Yeah,
there
you go. Perfect.
I'm like Barney Fife. They only give me one bullet. So, you remember that? Anyway, okay. So intervention, and it's interesting you say that because you're not the first one I've heard say that. I think the guy's name is Albert. I am live at something, and he was talking about that on a show I was with him on last week. And everyone knows that they're active. I mean, people know the plunge protection team.
Sure.
And, but people don't think that they'd come in and do an intervention in the, energy markets to, try and keep the whole, balancing act together. So then this would probably be a break to buy in crude because interventions normally don't work. The market is bigger than whoever's intervening. Isn't that usually the case?
Yeah, and I think it's here too. I mean, ultimately, like so much of Western policy in recent years and decades, like the releasing of the SPR last year, this will prove to be penny wise, pound foolish on an even shorter time scale. Because last week, U.S. shale basin participants were saying, look, we're not going to expand production because OPEC could come in and drop oil from 80 to 60 in a week. And then we're dead. So
our oil industry has post-traumatic syndrome. They don't they?
Well, they do. Yeah, they do. And so the way to think about this as a trader is, once again, the U.S. government, as in March of last year, March of 2022, once again, the U.S. government had a choice: the oil market or the bond market. And in 2022, they chose to save the bond market over the oil market. And that has got a cost ultimately, right? You put in oil price controls with the SPR release and aggressive rate hikes, and then you get what we had in the last 3 months in oil. You get shale production rolling over, as we're seeing. That's what you get. So you do this. This is desperation. This is what this is. And so, you absolutely buy this break in oil. It's we wrote to our clients on Friday, hey, we just had a spidey sense that oil could get whacked here. We wrote that in our report. It was the first time I've written negatively about oil in like forever. And said we'd sold some of our oil positions, etc. And said that if we were managing a monthly book, we would actually move to buying puts on oil. Better lucky than good, I guess. But I would be taking those off and buying oil here, because all they are doing is reinforcing the future supply shortage of oil and making it much worse, because they are reinforcing in U.S. shale's mind, you can't grow production. It's not safe to grow production. And so production won't grow. And in fact, the geology of shale ensures they will continue to suffer from that steep decline rate. So just a really, it is what it is. It's good for TLT for a cup of coffee, but again, it doesn't, it's penny wise, pound foolish.
All right. So TLT, I think the only thing that could save TLT is, just like the Fed will sacrifice every other market to save the bond market, they need to crush the stock market to have some type of money flow, even though people have PTSD on bonds too, that they never work even during a liquidity crisis or a big bear market. Maybe this time they would. Can they crush this equity market, are they on the way to being successful in doing it? Or is this just like a lot of the bulls say, a pause to refresh, normal pullback in a ongoing bull market?
They can try to do it. I've heard a number of bond bulls say that's what they're going to do to save the bond market. The problem is that it won't work. If they crush stocks to save bonds, they'll crush bonds too.
Okay.
And I've been highlighting for years that the key marginal driver of U.S. consumption and tax receipts is the stock market. And for a while, people for a while said it was crazy. And last year was sort of the piece de resistance of proof that I was right, which is unemployment was 3.5%.
Right.
Withheld tax receipts never fell, and tax receipts fell 20%. Why did they fall 20%? Because non-withheld tax receipts fell sharply. What are non-withheld tax receipts? Capital gains and stock comp, executive-based stock comp. So if they so last year, the downdrift in the market, which didn't even last the full year, by the way.
Right, into October. Right.
Yeah, it knocked $500 to $600 billion off of tax receipts, which means it increased treasury issuance by $500 to $600 billion. It increased the deficit and treasury issuance by that much into an already existing treasury supply demand mismatch. And people say, well, that means they just have to do more. They have to hurt the stock market more. If they hurt the stock market more, they will put the economy into a recession. You put the economy into a recession. The last 3 recessions have seen U.S. deficits rise by 6%, 8%, and 12% of GDP. 6% of GDP is $1.6 trillion more in issuance. 12% is $3 trillion more in issuance. So that would take our deficit from the 2.2 it is today to 3.8 to 5. Now, in a recession, the banks are going to have enormous credit losses. They're already moving in that direction with credit, with commercial real estate. Credit cards will probably come, auto loans, it'll all come. Well, the banks were regulated into buying $4.6 trillion in treasuries and mortgage backs.
At the highs when TLT was 1.7. Right.
Yeah. Oh, and this has been a 10-year process. It started in 2014 when the Chinese said we're done buying treasuries. Banks were regulated into it. Money market funds were regulated into it. Pensions were regulated into it. And then in 2020, to your point, the banks at the absolute highs, they yanked the Fed took off SLR exemptions and said, buy treasuries yielding 1 at the 10-year with infinite leverage. You don't have to have capital requirements. They encouraged the banks to put on an infinite leverage buy of trillions of treasuries with the 10-year at 1. And so if you have a recession, you're going to have the deficit blow out by $1.6 to $3 trillion, more supply. You're going to have $500 to $600 billion at least if we just equate from the modest selling last year to the tax receipt implication. You're going to have the dollar go up in a U.S. recession. And if the dollar goes up, foreigners have $7.5 trillion in treasuries to sell, and they will sell them until their hands bleed because they're going to need dollars. The banks are going to be taking credit losses. They will sell treasuries until their hands bleed. They have $4.6 trillion at the peak. They've only sold $500 billion. They were creating enough dysfunction in the treasury market in March that the Fed had to step in with BTFP, which is just a swap line for the banks so they don't have to take the capital losses selling treasuries. So the point here is that I've seen multiple very respected people say they just have to crash the stock market to drive a bid for bonds. I can't tell you what a galactically bad idea that would be. But if they crash stocks to drive a bid into the bonds, what they will do is crash the bond market too, because the supply of treasuries, we haven't seen supply yet. There will be 6 trillion, 7 trillion offered, and nobody has the balance sheet. Nobody. I mean, global GDP is 90 trillion. If it was growing 5%, that would be 4.5 trillion. The U.S. deficit the net effective treasury supply would be over 100% of growth, which means, okay, they'd have to sell other things, but it goes into a death spiral. If they crash the stock market, the system goes into a death spiral. including bonds. There will be no bid for bonds.
Okay, and I'm looking at the regional banks here, Luke, and you know, with TLT making new lows, taking out the October lows, if they had problems in March, their problems are even bigger now with their books for their long duration trade that you said the Fed regulated them into, or the regulate. Okay, so the Fed told them to do this. The Fed knew then when they went on their tightening regime that this was going to damage the banks big time because they didn't put out any note and say, hedge, get out.
Well, my understanding is
why did they do that? I mean, it almost seems like it was by design. You get someone to take the bait and then you pull the rug. I have this, you know, kind of outer space view that the Fed by design is creating a confidence crisis in the banking system. So a year or so from now, the CBDC could be a fix that the public will be so worried about their holdings in banks. And perhaps maybe by then, this dollar rally is over. And, you know, we start to have a bear market in the dollar, and it's good. This would give them the ammo to replace the physical cash, get rid of cash and go CBDC because they'll say it'll fix everything.
It's entirely possible. And if that's the case, that's sort of the end of the country, to be honest. We're no longer a democracy. We're a centrally planned
right. Well,
communist country.
Do you think it's going to happen, Luke? I mean, I
hope not. I hope not. But
okay.
It's very possible. But it's, yeah, these, you know, the banks, they were regulated into it. My understanding is that if they hedged, they were not allowed to classify the bonds as held to maturity. And so they would have had to have taken, they would have had to written the losses into earnings if they hedged.
Okay.
So
look at all these banks.
Oh, and this is why I say, like, crashing the stock market is to drive a bid for bonds. It isn't going to work because, like, Larry McDonald had a tweet out a couple of days ago. He said at 4 to 5% rates, Bank of America is 45x levered. At 6 to 7% rates, they're infinitely levered. They're insolvent. It's over. And that's before, I mean, that's before we get into like credit losses. So like, I think what we're watching in bank stocks is just the market saying, if you sell these bonds, you're going to have to take these losses, and these losses will wipe out a substantial portion of your capital base. And therefore, we are just going to sell your stock down to a level that reflects that wipeout of that capital base. And like I said, if they don't get the dollar down and they don't get oil down big, and like I said, okay, they bought time with oil, they bought time, but nothing else has changed. They are this, okay. The Fed has triggered off a doom loop that will take down. I mean, it's a systemic risk.
Okay. So that, you know, I mean, to me, it sounds like you're looking at the dollar with this recent rally, and gosh, look at this persistent rally, Luke. This is a record in the dollar. I think 13 weeks up.
Yep.
All blue candles.
Yep.
So are you in the camp, kind of like the Brent Johnson camp, the milkshake theory, that the dollar's this was not an important high that we put in at 114 in 2022, and that we're going to blow past it?
I concede that is entirely possible. I don't think it's going to happen for a simple reason, and that is that the United States Treasury market will crash like October 1987, like September 2019 in repo, like the gilt market. And I'm going to be careful because
will the crash cause a flight out of the dollar finally when people really throw up their hands?
It'll cause a turn. It'll
turn the dollar.
Gold. What will turn the dollar? What will turn the dollar? The Fed coming in and saying we cannot afford 7% rates. That's the thing that I think the big thing I hear, you know, the dollar milkshake, and Brent talks about the Soros imperial cycle of the dollar. the Stan Drucken or the Druckenmiller Soros strong dollar playbook, right? Where you run big deficits and you squeeze the dollar higher. They always leave an important part out relative to that Soros imperial cycle of the dollar, which is when we ran that playbook, the United States ran that playbook in 1980, US debt to GDP was 25%, 30%. Deficits were 2%. When the Germans ran that playbook for the Deutschmark, as Soros famously is quoted, or excuse me, Druckenmiller is famously quoted on, when the Germans ran that with reunification in 1990, German GDP or debt to GDP was 20%. After reunification, it was 40. The United States is 120, plus cash flow negative entitlements coming on balance sheet, plus deficits of 8% plus. So you don't get to run the imperial circle on the dollar unless you're willing to crash your treasury market.
Okay.
And if you crash your treasury market, that's the collateral backing your banking system. Banks are gone. Treasury market's gone. And at some point in this process, people are going to go, oh my God, the risk-free asset has risk. My money in banks has risk. Where do I go? And
CBDC.
That's what they'll do.
Yeah.
that's what they'll do. And the reality too, I think, is you'll see the gold markets start to rise with rising rates. I mean, it's already been puzzling to a number of people why gold has not crashed with the spike in rising rates or rising real rates. It's completely diverged from real rates. I think that will
until recently, it's finally caving. Who's behind this? Is this the Fed too?
I would bet it probably is. Yeah, I bet it
okay, because I started buying physical yesterday, and I haven't done any leverage trades yet. But I think that this could be a generational low here.
I agree.
1780 in the next few months. That it's the only way I can think about getting through this is with gold and silver and maybe speccing in mining shares. What do you think?
Yeah, and it's the way out for the government too, actually. The Fed's operating manual says at any point, Treasury can instruct the Fed to revalue the gold. And so if I was running things, let the Treasury market really get desperate, right? The only way Wall Street is going to accept $10,000 gold, $20,000 gold is if they're on their knees begging. So let the Treasury market crash to 8 or 9%, 10%. They're all begging. The banks are all begging. Everybody's begging, save us. And my solution is ring, ring. Hey, it's Luke at Treasury. Powell, every $4,000 in the price of gold is $1 trillion that gets deposited mechanically into the Treasury general account. I want you to write the gold up $25,000. Let's do 24,000 for easy math because it's one for every 4,000. I want you to write gold up $24,000 per ounce in the U.S. official account. That's the new price of gold, and that will deposit $6 trillion into my TGA. The $24 trillion Treasury market with rates at 8 or 9 or 10% has been written down to 12. And I step in with $6 trillion and I buy it back for 50 cents on the dollar. The U.S. debt to GDP is now 50. Fed can lower rates. Fed can do whatever. Fed can be independent again. Have a good day. Thank you for your donation to recapitalizing the United States bondholders. If you own physical gold, feel free to take it to your local JP Morgan branch and deposit it where they will credit your account for $24,000 per ounce. And I think that's how this is going to go.
Wow. What do you think silver would be? $20? because they're revaluing gold, and the gold silver ratio goes back to 200 or something like that. All right.
I think silver goes up, but not nearly as much as gold.
Okay. All right. And any vibes on BOJ and when they're going to give up yield curve control? Because I mean, there was this weird spike the other day in the end, and everyone thought maybe this was intervention, but no one could confirm it, and the BOJ guys aren't talking. What do you think's going on here?
I think they are increasingly desperate, and they are a if what's happening in the treasury market is a fire, they are gasoline on that fire. Look, what we're watching is the first global sovereign debt bubble in 100 years burst. Okay. And that's what we're watching. And what Japan's role in this is they're on the opposite side of the US net international investment position. They've got a positive net international investment position of 60% of GDP, right? So they own $3 or $4 trillion net in US dollar assets. And they will, when they need to, they can sell dollar assets until their hands bleed and throw it onto the lap of the Fed, throw it onto the lap of Treasury. Sell me more treasuries to defend my currency. Send me more treasuries, sell me more treasuries, sell me more. It's not our problem. And they can do this for a long, long time, a lot longer than the treasury market can afford this. A lot, if the US government had 25, 30% debt to GDP, who cares? Now at 120, Japanese go, sell some more, sell some more, sell some more. And all of a sudden, US government's going, we can't afford the Marine Corps. Now we can't afford the Marine Corps and the Navy. Now we can't afford the entire DOD because our interest expenses. So now we can't afford it. The whole budget is interest. And that'll probably happen before Japan runs out of treasuries to sell.
Okay, I think we just uncovered what could be the catalyst for a bear market in the dollar.
Yeah, they've got to weaken if the dollar doesn't go down, like oil buys some time. It does. What they did with oil buys some time. Whoever did it, whatever, if it's organic, I doubt it, but whatever. The decline in oil buys a little time. The dollar needs to go down 10%, 20%. And if it doesn't, like you buy oil and you go back to sell, you buy this oil tank and you sell this treasury bounce that we had yesterday. Because there's nothing, and you buy the dollar weakness yesterday. There's nothing stopping this, and gold will do crappy, probably down to your level, and then gold will start rising even as rates rise. And people go, "Why is that happening?" And the people in Argentina will go, "I know why it is," and the people in Turkey will go, "I know why gold's going up with rates," and the people in Brazil will go, "I know why." Like every emerging market in the world that I talk to is watching what's happening here, and they're like, guys, like, hello, McFly, just because you're Westerners doesn't mean you get a pass, on debt. 98% as of 2021, 98% of countries going back 120 years that had debt to GDP where US debt to GDP was in summer of 2020 and deficits where they were in summer 2020 and 2021 defaulted on their debt. Mostly in inflation terms. They mostly inflated debt to GDP down, sustained period of very high inflation. A few did restructure the debt. Now that was as of 2021. In the meantime, the one country out of all of them, out of 54, to get to that 98% that hadn't defaulted was Japan. What are we seeing happen to Japan? Things ain't going so good in Japan now, are they? So we're really looking at a 100% chance going back 120 years, which, as you know, Dale, 98% shots in this business don't come around much, let alone 100% shots. And so people always say it's never different this time. The key is the path and managing your chips. But like this global sovereign debt bubble is centered in the West and it is accelerating, and there's nothing's going to stop it unless the dollar is devalued meaningfully. Oil down buys it time, but failing that, you got to get the dollar down big. And that's going to have to come from some sort of big agreement, intervention, etc.
Like a Plaza Accord in reverse.
Exactly. And that ain't going to happen because we're busy trying to kill China and Russia's invaded Ukraine, and we just cut off Europe. European leaders, oh my God, like I don't know what they're thinking.
Yeah, I mean, so many pots on the oven bubbling over.
Yeah, you're not going to get any cooperation.
Yeah, and I've never seen you more amped and with higher level of conviction. Tells me that we're in the later innings of things you've been talking about here on From the Forest, From the Trees, right here, the forest for the trees. Luke Groman's website. You could follow Luke on Twitter at Luke Groman. Check it out. And I've seen so many great testimonials of people that during these times, I felt pretty agitated with everything going on, the test, and now the U.S. can't. I forgot the name of the company. They won't move our ships. They're butting up with China, so now we have logistic. Yeah, now we have logistic issues. That's really a bad supply chain issue to have, not to be able to move your military. So I've read how you bring a sense of peace and calmness to people once they could see through all the noise, and that they're able to go on living their lives and feel like they're on course. So
thank you.
Great mission you're on, Luke, and you've been talking about this for a long time, where it seemed like it was some time off in the distance. Seems like the curtains have lifted on this and the play has begun.
Oh, absolutely.
All right, Luke Groman, everybody, thank you so much, my trading warrior brother. Great having you. I learn every time you and I have a conversation.
Oh, likewise. I appreciate you having me back on, Dale. Always enjoy it.
Luke Groman, and everybody, follow him. Should be important to your intelligence gathering. Check out his writings. It will help you navigate, or not have to worry about navigating what's coming. So that's a wrap. Thank you, everybody. Hope you enjoyed, and you could join the team in 14 minutes on the Morning Edge, and we'll see everyone for the NFP Trade It Live with us tomorrow, and looking forward to reacting to the reaction. See everyone tomorrow. Adios. I'm glad you liked it, Sherry. I'm glad you enjoyed that interview. Luke's awesome. Adios.